So welcome back to Mindshift Theory, and specifically if you are a Wealth Circle member, we are always trying to bring you timely information. And this week we are going to mix it up a little bit. I think I'm going to make this a regular weekly video. And what are we talking about today? We are talking about sector rotations. And Ricardo, why the hell should I actually care about sector rotations? Well, if you're building a dividend portfolio or a portfolio of any kind, right, whether it's growth stocks, whether it's dividend stocks, and you are weighted in, let's say, the tech sector, and the tech sector took a dive, then your portfolio is taking a dive as well. There is no reprieve for you, right? So that's why people are always saying, diversify your portfolio, diversify the stocks that you are in. And that is true for everything, right? That is also true if your portfolio consists of property and stocks and cash, right? Always diversify that portfolio so that you don't take one massive hit when one sector or one asset class basically goes down. And this is why I think this video is actually extremely important, specifically on a weekly basis, just to understand exactly where the rotation is actually happening from an equities perspective, so that you have more informed information with regards to, your dollar cost averaging strategy or your buy and hold strategy. So with that, let's jump in. Okay, Ricardo, so which sectors are leading and which ones are falling? And to give you this information, we actually built a tool within the Wealth Grid platform. It's called the pre-market prep, but it will also give you a sector rotation over the past 5 days. Now, how this tool works, it basically takes 16 tickers, which is sectors, right? The sectors within the S&P 500, and it basically ranks them, which ones are up and which ones are down over the past 5 days. And then it spits out the top 3 and the bottom 3 as well, just so that you get a good idea of exactly where sectors are rotating to. So first, let's jump into the pre-market prep tool, and then I want to give you an idea of what that actually means from a trading perspective when we actually go and look at these sectors, which tickers are in those sectors, right, that you need to be aware of. And that's going to give you a whole host more information in knowing exactly where should you be dollar cost averaging and where should you actually be thinking about taking profits. Okay, so with that, let's jump in. Okay, so we are in the Wealth Circle, and it was a tool that we built to track our portfolio, right? In this tool, you have everything from, managing your holdings, seeing your entire portfolio, understanding the dividends that your portfolio is actually paying you, doing analysis, a whole host of different things, right? But we also have this pre-market prep section. And the pre-market prep section is basically for, intraday traders or swing traders to come in and say, what is the market actually saying today? Pre-market, right? Give me some analysis on SPY, on QQQ, on DIA, any tickets that you actually are looking for pre-market information for to set you up for the trading day. But in this instance, we are going to be looking at the sector rotation, because that is a fundamental part of actually understanding what you want to trade for that specific day. And the sector rotation tool is looking at 16 sector tickers within the S&P 500. So you've got a broad spectrum here of what's trending up and what's trending down. So the first top 3 sectors is DRAM, MAGS, and XLE. And the bottom 3 sectors is XLB, which is a very small component of the S&P 500, biotech, and then we've got the healthcare. Now healthcare is the 4th largest sector within the S&P 500. So this is one to actually take note of. Now I'm going to jump into our actual trading platform and actually look at the tickers that is in these sectors to give you a little bit more information of what tickers you should actually be looking at within that specific sector, right? That is relevant for that sector being up or that sector being down. So with that, let's jump in. Okay, so we're looking at the first one, which is DRAM. DRAM is a memory ETF, and within that ETF, there are stocks like, let me just pull that up, like Samsung, right? Like Micron, SanDisk, Western Digital. These are all of your memory stocks that you actually need to be aware of. And when the sector is up, these names are actually trending. So one of the reasons why memory stocks are up over the past 5 days is because SK Hynix was actually listed on the NASDAQ stock exchange, right? So this has been up by a massive percentage over the past couple of days. And that has basically pulled all of the memory stocks up with them, both SanDisk, MU, Western Digital, etc. Okay, so now we're looking at the MAG 7, and you should be familiar with the MAG 7 already, right? It's all of the top holdings from a information technology perspective. We're looking at Apple, we're looking at Nvidia, we're looking at Microsoft, we're looking at Tesla. It's all the big boys essentially in the MAGs. And you can see that there's been quite an uptick in the Mag 7 over the past couple of days. So the Mag 7 has undergone this V-shaped recovery here, right? And it's actually broken out of its consolidation box. I'm just going to draw that in so we can actually get a better picture of it. And it's broken out of its consolidation box on Friday. And you can see that there's been quite a lot of volume that has been accompanying this, right? So what does this tell me? It tells me that there's a lot of institutional investors actually putting money back into the Mag 7s, right? And what is the Mag 7s? Well, let's take a look at what the Mag 7s actually are. So the Mag 7s is known as the Magnificent 7, right? And we're just going to take a look at the holdings that's within the Mag 7. And it's going to be names that you already know, right? It's going to be your Meta, your Apples, your Nvidias, your Microsoft, your Amazon, your Googles, and your Teslas. And we've seen quite a rotation back into tech again. These stocks were so beaten down over the past 3 or 4 weeks that I think investors got to a point where that they said, look, I need to protect my dollar cost average, right? And we think that now is a good time for capitulation, right? Sending the stocks back up basically and plowing some money back into the tech environment. Okay, so the last of the top 3, right, for the past 5 days is also energy. And energy has been very volatile over the past couple of weeks, months, so to speak. And you can see it in the charts, right? Down, up, down, up, down, up. And this is volatility that has been created due to the Iran war. Again, I am not playing energy stocks just because of this volatility, but it is up at the moment. There is a consolidation box that is actually bouncing off right now. And again, for myself and my own purposes, I'm just staying out of the energy sector and any of the energy stocks. And these energy stocks we will discuss a little bit later on in this specific video and just run through some of them as well. Okay, so what are the laggards here? The laggards is XLB, which is a very small component of the S&P 500. It's not going to move the markets exponentially. Again, XLB is also just in a consolidation zone right now. So, this is not something that is going to move the market exponentially. Basically, we're sitting right slap bang in the center. And later on in this video, we're going to go through a little bit more analysis on XLB. So I just want to front load this video with information that's actionable for you so that you don't have to wait until the end of the video to actually get the information that you're really looking for, the information that's actually going to help you make better investment decisions. And with that, let's move on to XLV, which is one of the other laggards, right? Now, XLV is important purely because XLV makes up roughly about 9%, almost 10% of the S&P 500. So when your healthcare stocks are actually pulling back, you need to pay attention, right? So just let's take a look at what's actually in healthcare so that you know which stocks it is that you are actually looking at, right? Within the specific sector. So within the XLV sector, you're looking at EY Lilly, J&J, AbbVie, United Healthcare, Amgen, Gilead, Pfizer, CVS. So some of the really big boys, right? And some of those stocks that are dividend kings or dividend aristocrats, a lot of these stocks are in our portfolio. A lot of these stocks are in portfolios specifically for dividend investors, right? Which we are. So be mindful that these stocks are currently pulling back from the all-time highs. I know for us, we sold some of AbbVie recently purely because it has actually made an all-time high, right? And one of the most important things for newer investors to actually wrap their head around and kind of make part of their process is to be able to sell at the highs and buy at the lows, right? You always get very invested in your P&L. And when the stocks goes up, your P&L looks great, right? But it's unrealized gains. That positive P&L can disappear quite quickly as well if the stocks retraces very, very fast. And this is normal, right? Because investors that has invested in that specific stock, once it gets to the all-time highs, they want to take their profits. And it's normally larger institutional investors that has actually invested in these stocks that has pushed them up to the highs that they are at. And then they're just looking for retail investors for liquidity, and the stock basically starts coming down, right? So be careful of that. Always be looking at your technical analysis to understand when the optimal time is to buy and when the optimal time is to sell. So go and take a look at any of the healthcare stocks at the moment. In fact, I'll do AbbVie right now because it's something that we've just taken our profits on because of exactly this scenario that you're seeing, right? I'm going to draw this in here so that we have a better idea. You can see that AbbVie has had quite a massive run, right? One leg up, consolidated, another leg up, consolidated, and one massive run. And now we're basically at the all-time highs here. What's happening at the moment is that, a lot of institutional investors is actually taking profits, right? And we've had one, two, three, four, five, 6 down days. This is the time where you need to think about, do I take some profits off the table? Do I put some cash back into my pocket? And do you wait until you find a better buying opportunity? For us, we're probably thinking about a bounce off the 20. If it does have a deeper pullback, we're probably looking at about the 128 number from a dollar cost averaging perspective. So those are the top 3 sectors as well as the bottom 3 sectors. I know that we've only done 2 of the bottom sectors. The other one was biotech, which is not one that we invest in because it's super volatile as well. So I hope that that has given you a good backdrop as to, the trending sectors over the past 5 days and the ones that are actually lagging as well. And with that, let's jump back into some of the other sector rotations that's actually happening. So I'm going to start all of the analysis every single week by taking a look at where we are from a weekly basis, right? And if you are new to sectors, let me give you a quick rundown of what they actually are. And the easiest way to actually explain this is to show you what they actually look like as it relates to the S&P 500, right? So I'm in the S&P 500 and I'm going to look at all of the sectors within the S&P 500. And I'm looking at the SPY ticker, which is basically the S&P 500, right? In the S&P 500 or in SPY, you will see that there are already sectors within this this fund, right? This equity, this index, essentially, at the end of the day. And they are made up of a couple of different things. They are made up of information technology. And within that specific sector or basket, right, or theme, you will have all of the stocks or equities that is related to technology. You've got your NVIDIAs, your Apples, your Microsofts, your MUs, your Intels, your Palantirs. A lot of these will be familiar names to you, right? They're all in the technology sector. So if the technology sector pulls back and all of your holdings is within these stocks, your portfolio is going to take a dive, right? Then you've got the financial sector, right? JPMs, basically all of the banking sectors, right? That's your financials essentially. Then you've got your communication services, and these are communication services as in platforms out there, the Googles, the Metas, the Netflix, the Verizons, the Comcast, the T-Mobiles, all of your communication stocks or equities will sit within the communications sector essentially. Then moving on to that, you've got discretionary. Now, discretionary is on any of those things that, you discretionarily buy as a consumer, right? You might buy from Amazon, or you might buy from Tesla, or you might go to Home Depot and you might buy some, goods for renovation, right? And as a consumer, you might go on a Royal Caribbean cruise or, want to understand where Ross stores are and are you going to be spending money on new clothes, right? Or Airbnb or eBay. Those are all within your consumer discretionary. You choose whether you actually want to spend money within these sectors, right? And normally this consumer discretionary sector is up when people are feeling good about the economy. If they're not feeling so great about the economy or the interest rates are high, then people are normally a little bit more mindful of how they're actually spending. Then, of course, you've got healthcare. We all need healthcare. And these are all of your big healthcare names, your EY Lilly, your J&J, your AbbVie's, your United Healthcare. They all kind of sit in this sector. Your AbbVie's, your CVS's, all within the healthcare sectors. Now, industrials are everything that is related or tangential to actual building stuff, right? They are part of the industrial sector. You're talking about your CATs, your GEs, your BAs. Those are all equities that actually sits within this industrial sector or vertical. Then we come to consumer staples. These are all of your day-to-day stuff, right? Where are you buying your groceries? You're buying it at Walmart, Costco, Coke. Pep is in this specific vertical, right? So it's your consumer staples, the stuff that you actually have to live, right? And normally these are very safe sectors to actually go and invest in. They are sectors which everybody needs, right? Everybody needs food from Walmart or Costco or everybody buys snacks from Pep or Coca-Cola. Everybody must buy, toothpaste, etc. So you'll find that there's rotations happen into these consumer staples when things are uncertain in the market. People will rather put their money into companies that has been around for years and years and years, decades even, that actually pays the dividends, versus putting their money into a growth stock, for example. Let's say MU is a growth stock at the moment. There's INOQ. There's loads of growth stocks that's actually at the forefront of today's market. But those are normally when the technology actually changes, as it is at the moment. AI is changing the landscape completely. Memory stocks are up there. You're talking about quantum computing. These are all growth stocks, right? You don't really know whether they're going to pan out, but you're taking a bet on them because they have this exponential growth. Whereas consumer staples is kind of, your boring, stable kind of companies that's been around forever that people are going to need, right? And then the energy sector is self-explanatory, right? You've got your Exxon Mobils of the world, your Chevrons, and all of the energy producing companies that is out there now. When there is turmoil in the world, like there is now at the moment, right, with the Iran war, energy has been at the forefront, and you've seen energy spike to like $110 per barrel recently, and it's come down because of the de-escalation that's actually happening. But the energy sector has a tendency to actually create a lot of volatility within the market in a short period of time. But the effects are actually felt in the market for a long period of time. Why do I say that? I say that because energy is utilized to move goods around, right? Energy is utilized to produce goods. Energy is utilized for pretty much anything that we actually build, create, consume. And because you have this knock-on spikes in energy, the effects are long-term. So you'll see some of these effects come into, your transportation costs, your air flights, your price of food, right? Because it needs to be transported, but they are kind of lagging essentially. So just bear that in mind, specifically when you are thinking about, long-term investing into let's say consumer staples or discretionary products, essentially, with a massive fluctuation in energy and energy pricing that we've actually seen recently. There is going to be an impact in inflation. And how does inflation actually impact any of the equities that you plan on dollar cost averaging in on? Just something to keep in the back of your mind. Now, there's two more to actually go through. Utilities, obviously, and these are all of the energy producing utilities that you use on a day-to-day. Your Southern Energy or your Nextra Energy, Duke Energy, people that's supplying energy to your home, whether that be through solar, whether that be energy that is produced through wind, or whether it's just nuclear energy that is actually being piped into your house. These are those type of companies. And then we've got real estate, and real estate again is kind of self-explanatory. These are all real estate companies. We own quite a lot of O, purely because it actually pays us a dividend on a monthly basis. And real estate is also very sensitive to interest rates, right? Right now, getting a mortgage in the US is expensive. It is at one of the highest rates that it's actually ever been. So, your real estate stocks also takes a beating because they can't actually sell any of their inventory. And last but not least, we've got materials, right? And materials is those raw materials that actually gets produced. And that sector is the smallest sector within the S&P 500. And that's a good segue into going from smaller sector to larger sector. Now, why is this important? Because materials makes up the smallest sector within the S&P 500. If materials spikes, it's not going to move the pricing in the market exponentially, right? Even if it goes up by 20%, it's not going to make a big difference. Neither is real estate, neither is utilities. Energy has a long-term impact on commodities, on anything that we produce. But again, the holdings from a percentage perspective within the actual broader market is tiny. Now, what does move the market, Ricardo? Well, information tech, right? If Nvidia is having a bad day, or Apple or Microsoft or MU takes a dive, you'll see the stock market take a dive almost immediately, right? Specifically the S&P 500, and more specifically the NASDAQ, right? Because it's super tech weighted. The Dow, not so much, because the Dow has a lot of staples and a lot of dividend paying companies. One of the reasons why I trade the Dow myself. The other sector that's actually going to move the market exponentially is going to be financials. Financials are the second heaviest weighted sector within the S&P 500. 10% basically of the S&P 500, right? Information technology is almost 40%. Financials is 10%. That's literally 50% of the market, right? The market cap. If those two falls, you're going to get a massive drop in the actual value of stocks within the S&P 500. You're also going to see that within the NASDAQ, within the QQQ index. You're not going to see it as much within the Dow, although it will be down as well. But just bear that in mind. The next three heaviest weighted sectors within the S&P 500 or within the SPY index is going to be communication services, discretionary, and healthcare, right? Those three are going to play a large role in kind of keeping the markets stable, so to speak. And then, of course, you've got industrials that follows that, as well as consumer staples. And you can see the percentages right next to the actual sectors that I'm pointing out here. Okay, so now you've got a really good idea of the sectors and how they fit into the actual broader index, into the broader markets. Now let's go and take a look at a couple of charts so that we can actually understand where the sector rotation is actually happening, because that's the premise of this video, right? Where is the sector rotation happening? We'll start off with XLK. Let me just maximize the chart here. So this is a daily chart. All the charts that we're actually going to look at is on a daily chart over a full year period. And as I go through the technical analysis, I will explain some of the things that I'm actually looking at here, right? So let me just increase the size of this. So this is XLK. This is your technology sector. And you can see that the technology sector has kind of been, consolidating in this range. Right now, there's nothing to do kind of slap bang in the middle of this range, right? You're kind of right here. The good thing here is that you are actually holding the 50 moving average. This is your 200. Now, one of the other things to note here is that your Friday close, which is this green bar here, came in at really, really low volume. That means that there's not really institutional investors that's stepping up here. On your RSI, we're basically just above your 50. And on our MACD, we can see that we're actually still losing momentum here, right? So for me, XLK still actually has to prove itself. Is there going to be a trade in the upward direction on XLK? I think we're going to have to have the institutional investors step in here. The next one that we're looking at is XLE. So XLE Energy, again, you'll see that you've had a massive run up, right? This is because of the Iran war. And you'll see you had this massive chop over the past couple of days and weeks. And that's because, yes, we have a ceasefire. No, we don't have a ceasefire. Yes, we're going to bomb them. No, we're not going to bomb them, right? And this green line that I have on top here, this is the 5-day pre-memorandum of understanding. So we had kind of consolidation that's actually happened. And then, we had the bombings that actually happened again, and oil has tanked, right? Now, again, this is one of the reasons why I'm not touching energy at the moment, because there's just so much volatility within it. On the positive side, one of the good things is that we actually have had a consolidation zone right over here. Let me just draw the box so we can get a better idea. We've had a consolidation zone that's actually happened there, and we've stayed above that zone. And I think prices are probably going to be balancing in this zone somewhere over the next few weeks or so. Okay, so that's energy. Okay, so healthcare, let me just make this a little bit bigger so we can see what we're doing. Now, healthcare has had quite a bit of a run up, right? Quite a bit of a run up. We're probably looking at a bit of a flag here. Healthcare still looks constructive. I think that there's just investors that's basically taking profits off the all-time highs at the moment. We do have a well-defined support area right here. We can also see that, our RSI is above your 50. As well as your MACD is well above your zero lines. So healthcare, yes, still looks constructive for me. It's above the 20, it's above the 50, it's above the 200. You can still have a pullback that actually falls through this resistance point over here, but then it will meet the 20 where you can actually expect a bounce somewhere. Okay, so that's healthcare. Let's clear that up. So XLU also kind of in a balance range here. It's above the 20, above the 50, above the 200. And normally when you have all of your moving averages stacked like it is at the moment. You've got the 20, you've got the 200, and you've got the 50 stacked all in one location. It's basically acting as support, right, for that specific sector or that specific stock sometimes as well. So I wouldn't be surprised if this actually goes sideways for a bit, as the moving the averages is actually holding it up, right, as a resistance point, and then to see further upward momentum within the XLU sector. Okay, let's jump into XLP. XLP2 here is in this range, right? And for me, there's nothing much to do at the moment until the market tells me otherwise, right? You literally slap bang in this range. For me, playing in the middle is never a good idea. I'm either looking for something that looks like that, right, or something that looks above and fails, comes back out, and actually moves further downwards. So that for me is consumer staples. Okay, so let's move on to XLI. XLI has made a really nice move out of this consolidation box here. Let me just make that bigger. So XLI has made a really nice move out of this consolidation box that it was in for months, right? This consolidation box here. You see that you do have an upward trending 20, you have an upward trending 50, you also have an upward trending 200 day moving average. This consolidation that's actually happening right above this consolidation box. And I think XLI is actually doing really well at the moment because of all of the volatility within the markets. Industrials, you need industrials to make weapons, to move tech forward, right? Specifically with the AI trade, and that's where a lot of this gains has actually come from an XLI perspective. Just take a look at Caterpillar, right? Building out infrastructure for the AI trade. So I'm expecting consolidation to actually happen here. We might come back and test the consolidation box, but I do expect industrials to stay a little bit firmer than what it is today. Okay, so what are we seeing in XLF here? XLF again has had a really nice run, right? Leg one, consolidation. Leg two, consolidation. We're kind of on leg three at the moment, and we are consolidating. Now, we're above the entirety of the stack from an SMA perspective, and finance is having a really, really good run. It's actually one of the rotational pieces that's actually, keeping the market moving in an upward direction, which is finance and industrials, right? It has kept the S&P afloat, kept the S&P moving forward. There is also a ton of finance reporting and earnings that's actually happening next week. So expect a little bit of volatility within your finance sector. I do think that it's still looking strong from a technical perspective. It's well above your 50 percentile from an RSI perspective, and on your MACD you can see that there is still strength within the technical indicator, right? So that is finance, and I'll do two more because this video is getting really, really long. Again, XLY is in this consolidation zone, right? It's literally slap bang in the middle of the consolidation zone. For me, nothing to do until it gets to the ends, which is either a trade that looks like this or a trade that actually looks like that, right? It could also go the other way around. You could actually eat the bottom of the bounding box, and risk and reward can look something like this, or your risk and reward can look something like that, right? That's XLY. And one more that I'm going to do before I end this video, and that's going to be SMH, because I think it's an important one to actually cover. So let me go to the SMH chart quickly, and this is it. So again, you can see SMH has been pretty volatile over the past couple of weeks, right? You can see how the stock has actually moved. There's been a lot of gap and goes here, which is horrible from a trading perspective. Gap down, gap up, consolidation. You've kind of between your 20 and your 50-day moving average, right? The market is unsure about where the AI trade is actually sitting. Do we need more memory? Is the capex spend by all of these big companies going nowhere? Can capacity actually be reached? And there's a whole host of questions with regards to the AI trade, right? And this is why you've actually had the sideways movement over the past couple of weeks, essentially. But is the AI trade dead? Look, we all know that AI has exponentially changed our life. Is it here to stay? Most likely. The question is, is all of the spend that's actually being put into the infrastructure at the moment, is that going to heal profitability when it comes to earnings in a couple of weeks' time, right? And I think that that's going to be the big tell. You can also see that Fridays, even though we had a green day on Friday with SMH, there's been a lot less volume that has been transacted, right? And again, this is one of those things where I watch pretty carefully to see, is the institutional investors actually stepping up? And if there's not institutional investors stepping up from a volume perspective, then we shouldn't be stepping up as retail traders as well. For retail traders, always follow the money, right? When institutional investors puts money into the market, that's where you go and you put money into the market. Do not be liquidity for these large institutional investors. Okay, so that's going to be the wrap up for today. Our future videos are going to be a lot more succinct, a lot more timely, a lot more relevant to possible tickers within that sector that you should actually look at, right? This video is literally a grounding in what is sector rotation. What does it actually look like? What does the bundles actually look like from a sector rotation? How do they actually relate to the S&P 500? And what is their weight within the actual market, right? So that you know if tech is moving, your market's going to move up because it's 40% of the actual broader market. If finance is moving up, it's 10% of the actual broader market. Your stock portfolio will move accordingly. And that's super important to actually understand. Okay, so that's going to do it for our sector rotation video. And this is an introductory video, and hopefully you've actually found value in this. As I said, the weekly videos will be cut down to roughly about 15 minutes, and we'll give you a quick snapshot and overview of which sectors are moving and which sectors are lagging, right? And with that information, you will actually have a better idea of which companies in which sectors you should actually dollar cost average into, and which companies in which sectors you should actually be thinking about, taking some profits, taking some stock off the table, and keeping some powder dry for the next upturn, right? So if you enjoy this content and you found it valuable, please give it a like and share it with somebody that you think might actually, benefit from analysis like this, right? And keep an eye out for our weekly sector analysis, specifically if you are part of the Wealth Circle, because we will drop it in the Wealth Circle on the day that we actually do the analysis, and we will put it back onto YouTube probably about a week or 2 weeks after the analysis was done, right? We want to provide as much value for our members within the Wealth Circle, and this is exactly why we're doing the analysis. And with that, I will see you in the analysis next week.